Okay, good afternoon, everyone, and you are very welcome to another Coffee Microcaps webinar. We've got an exciting lineup this afternoon, and I am very much looking forward to it. I am just going to quickly run through a couple of intro slides, and then we're going to get straight into it with our first presenter. For anybody who doesn't know me, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'll be hosting this afternoon's webinar as well. A special shout out, as always, to RAS Research as a Service, our sponsor here for all our events at Coffee Microcaps. If you are looking for some research, both free and they have a premium tier as well on small and microcap names listed on the ASX, please do check out their website. As always, a very warm welcome to our friend Tomasic, if anybody is joining us. For people who might be joining us for the first time, companies we tend to have on here are capped under 300 million in revenue and approaching cash flow break even, or as you will see today, already profitable. We tend not to have companies from the resources and biotech sector, what I like to call industrial microcaps, which basically encompasses pretty much every other sector outside of those two. So financial services, media, professional services, healthcare, the whole gambit, basically outside of resources and biotech. Now we've got a packed lineup today. We've got 4 companies presenting for you, each for 30 minutes, which we break down into roughly a 20-minute present and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to the presenters. And please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us on Coffee Microcaps, Twitter, YouTube, LinkedIn. Just a quick call out on the YouTube channel. We've just clocked in at 2,000 subscribers now to the YouTube channel. Little milestone there for the channel. And I do write a free monthly newsletter, which will be coming out towards the end of next week. Generally goes out the first week of every month. Our first presenter this morning, we're welcoming back Adam Cadwallader from Motio. After that, then we will be welcoming back another returning presenter, hasn't been here for a while, Bruce Coombes from Quickfee. Then we will be joined by Subhash Challa from SenSen Networks. And then our final presenter today is Amos Simantov from Vat Ltd. I will leave it there. That's all my intro slides, and stop sharing my screen and hand you over to Adam. Adam, if you want to bring up your slide deck, I will let you know once it's up. Yeah, I can see the cover slide of it now. Adam, you can take it away whenever you're ready.
I will, and congratulations on your YouTube channel, Mark. 2,000 subscribers, very good. This one, I thought I'd also put my own disclaimer slide in for friends at ASIC, because they are very friendly. Thank you for having me, Mark. Always great to be here. Agenda, very simple, very short, starting with an overview of Motio, what we do, how we make money. I'll get some little, put a couple of little slides in there about our recent cap raise on Monday, and hopefully we can answer some questions at the end. For those of you, I guess, joining to see one of our presentations for the first time, this is an overview of the business, a few things included. And for those of you who have seen it many times before, thanks for sitting through it again. I thought I'd start by introducing you to our board and management team. Jason Byrne is our chair. He's got a specialty in retail marketplaces, wagering tech. He's a bit of an operational savant. Harley Grosso, who many of you in this community do know, he's a non-executive director. He's the largest shareholder of Motio under HG Capital. It's been enormous value to me personally and to the business over the past 5 years. And the three of us make up the board. Justin Kingston has just recently joined as a brand new Chief Operating Officer, and Jackie Smith, who's our financial controller, both, including myself, sadly, XO Media. But enough about them. Let's talk about Motio. we're a media company. Probably even some people in our industry would call us a publisher. We're trying to continually sort of redefine how brands connect with audiences in these places. We're really doing this through unique digital display network. And I say unique because, we call ourselves a place-based network, which is a little bit like outdoor advertising, but in long dwell time environments. So the network offers sort of the best elements of outdoor advertising, digital, video, and it's got dedicated digital display channels. So all of these channels carry this beautiful, dynamic, engaging, and very hyper-relevant content. And it's, as I said, it's tailored to the natural dwell times of the environments where the audience is engaged, which I shall take you through now. So look, what you can see on the screen here is our medical centres. So we generate our revenue by selling advertising and integrated campaigns on the displays in these environments. The medical centres target a huge number of people engaged in their health journey, and probably the largest user groups of medical centres. Like, we all go to the doctor, but there's some big user groups. So the first one that I like to talk about is people on the pregnancy journey. So women that are considering pregnancy, they are pregnant or they've given birth, and they'll attend a medical centre like 10 times in a year. And they're there for 25 minutes at a time. The second group is parents with kids. We all know that. Maybe I certainly have done my fair share of visiting the medical centre with my kids, but probably 1 in every 2 of those people, those sort of main grocery buyers, are also visiting a supermarket or a pharmacy straight after. So it's a great place for brands to connect with those people. And the third group is really older Australians. So probably, they're equally high user group, 60 to 75-year-olds engaging in sort of regular health maintenance. But as I said, we all visit, but these are the major groups that the brands like to work with us and connect. All of these are also, I guess our displays are a great place to get an organic driver to mobile search. So people often say to me, are people on their phone? Aren't people looking at the phone? I'm like, yeah, they are. But this is a great, connective tissue between the two, which is fantastic. As I mentioned, we're part of the outdoor advertising sector, but in simple terms, these displays get extra interesting. Here's our Motio cafe in CBDs. We're actually building out in urban areas at the moment to sort of high net worth suburbs and socioeconomic suburbs, which is going really well. So people not just working from the office, but also working from home, they often see the cafe as a bit of a third space to work from. The Motio Play channel, which is indoor sports, leisure centres. I guess, I don't know, for those of you who might have played indoor cricket, indoor soccer, netball, basketball, swimming centres. This is MSAC in Melbourne on the screen right now, which is an enormous location, very, very exciting. And at the end of June, just gone, we signed a long-term agreement with PCYC New South Wales, which added another 45 locations to our existing 80 location network. So it's been a fantastic channel to reach that core 14 to 24-year-old audience, really playing grassroots sports with their families, watching on. I think we've really strengthened off the back of this news and execution. What you see on the screen here is a recent picture of an installation we did at PCYC Ku-ring-gai, which is in Hornsby in Sydney's north. It's a mammoth location. But I think what we're finding is we're actually getting a lot of briefs from brands, reacting to the sort of social media crackdown that's happening very, very soon in the next month or so, where brands are looking for, safe environments to advertise to young people. So hopefully we're going to do very well. And then finally, everyone's favourite, certainly in here, is Motio Venue. We operate in bars and pubs across Australia. I guess these environments don't really need an introduction, but we put our displays at or near the bar, so we're capitalising on that, as I said, that natural long dwell time. I guess the audiences here are, we would call the tradie boardroom, after work drinks, late night warriors. So different brands can integrate into the environments at different times. So if you are, let's say, the new Amarok coming out, maybe you want to advertise it to the tradie boardroom, but you don't want to be involved in sort of drinking and driving later on in the evening. So you can just pick and choose the times that you want to target. So as I said, we own and operate these networks in environments which are really centrally controlled here from where I'm sitting in North Sydney. It really enables us to sell advertising across our entire network right down to a single location, single minute. It's very, very targeted. And look, whilst we're very much driven by that technology, content and connectivity, we're an ideas-led company with their real sales culture at the beating heart of our business. I think the one question we get asked a lot is, well, what's the moat? What's the point of difference? But I think we're really becoming well known for transforming places and driving the customer experience for these places beyond advertising. So this is about using the digital signage or helping the locations we're in use the digital signage to change their own customer experience for their own customers. So when we enter an environment, the displays that we put in, we want to enable all parties to win. So the customer, the location, and of course, Motio and its customers. So it's a big call, but we really want to add economic advantage to everybody that uses the location. And I think we are achieving that. Okay, this may be the last time that I can roll this out, but with relevance. But I was really pleased with the FY25 results, and the team worked incredibly hard, and we got a fantastic result last year. We had a lot of plans come to fruition earlier in the year. We sort of prepped for contingencies around the federal election. It ultimately kind of worked for us rather than against us. We had great revenue, 9.377, and our cash EBITDA 1939. Really, really strong results. I won't dwell on it, but to say that we were pleased with the results of the FY25 financial year was great. Obviously, the past 3 years have been great. We've had 30% year-on-year growth, which has been incredible to report. Better than reporting, I guess, the opposite. We continue to be cash flow positive, not just increasing revenue, but increasing utilization of the network, as well as we've got a proven sustainable business model, and we're really continuing that path of commitment to profitability. We had a very respectable Q1 with the added challenge of fighting against our freakish best selves of last year. So I previously reported this, but we made the strategic decision to exit our representation of the Ampol network very early this year and focus on our owned assets. So whilst our revenue was modestly down for the quarter, on the price corresponding period last year, there was $250,000 or so that was part of that previous network. So we've actually ended up in line with our last year's freak quarter, as I mentioned. GP's up 5% as a result of sort of reshaping our pricing and content management software provider, also getting rid of representation for the moment. Local sales continues to do really well alongside other sort of key programmatic revenue and drivers such as national and direct, which have been really good. Look, we really recently provided an update to the market beginning of last week that our cash EBITDA target for the quarter, unaudited management accounts basis, but we have we finished at about $700,000 for the quarter. We've got a really healthy bank balance. We've got $3.3 million in our bank, and we just did a cap raise on Monday up next week. Just to provide you with a further picture of how revenue has been shaped over the last 3 years on a quarter-by-quarter basis, you can see our freakish sort of Q1 last year, and then where we're traveling this year. But equally, that we're in very good shape moving forward. Revenue per location is, I guess, a metric that we use internally. It's been continuing to rise, noting we've sort of got approximately 300 less locations this quarter than we did on the last quarter, but that's been adjusted. Very pleasing result here to move on to that sort of $9,000 revenue per location basis. Look, I've said this a number of times, but our decision to grow into our networks, a bit like a child might grow into their shoes, has been a really good decision rather than running out and land grabbing. So we're operating on an average of around 72% utilization rate, which is great, but it's also given us the signal that we can invest in our networks and continue to grow revenue, which is a key reason for the capital raise and providing us with the opportunity to accelerate our existing and potential pipeline of new locations. So the placement on Monday was about 1.7 million before costs. Exciting for us, happened very fast and furious. Very happy to welcome a number of new significant small institutional shareholders, which has been very exciting. I guess the funds raised are going to enable us to eliminate the oOh!media vendor finance, which is actually happening today. We will pay that out today, about $860,000, $900,000 remaining. We can accelerate our pipeline, particularly in the medical center space, and implement some of our tech-based sales and marketing programs, such as our AI creative development for our local sales, and also enable our marketing automation programs across sales, commercial, and marketing, which is very exciting. I wanted to sort of just give a shape of this. This has probably been somewhat inspired by a number of investors, but also some questions out of some of the platforms in the market. But I thought it might be worthwhile to cover off how the unit economic works, or at least the fundamentals. So I don't know if you can see that, but it costs about $3,000 to $5,000 roughly to roll out gear, a screen, and all the associated gear at each location, regardless of where it is. From a revenue perspective, I guess we should be able to get our business casing is like, we've got to get revenue back in 1 year or under as a rule. And we business case that at 50% of revenue per location. So we have $9,000 revenue per location. We business case it at $4,500 revenue per location. Obviously, we're operating at an 80% gross margin and roughly a 20% cash EBITDA. So that means that we're getting full payback in a fairly short period of time. We depreciate the gear over 3 years. So there's about 5 years of useful life when well maintained. As I said, we get about $9,000 revenue per location in medical centers at the moment, with a combination of 4 different ad revenue streams across agencies, which is working directly with large media agencies with big brands, direct to advertiser. So usually probably bigger brands, but they don't necessarily deal with advertising agencies. Programmatic, which is the machines talking to machines, so buying audiences, and local business advertising, which we do pretty well out of. We don't sweat the assets, so we have about $400,000 baked into our operating expenses that covers repairs and maintenance across the network. This works out to be about $20 per kit per month. We have a lot of investors ask us about that because they're like, do you have to keep investing capital? What happens there? No, we have a maintenance program that goes on with our displays. We're actually making some changes to our other cost line, so it's a bit more visible and transparent to shareholders in our reporting this year. And finally, one of the questions I get asked a lot is, are we trying to be another oOh!media? Are we another Mini Out of Home? We've got a lot of oOh!media ex people here, but no, we're not. For those of you that might be thinking that, I think I mentioned earlier, we've got a really strong customer experience model for locations that are not looking to be big. In the outdoor game, it's all about landlord style of operation. So give them a check. You can put a billboard in, or maybe it's a bus shelter and infrastructure for council. We're really working with what I would call unsophisticated landlords. They don't need our money, but they do really appreciate the opportunity to market their own business. We can help them creatively with templates that are available through our cloud-based program called Creator that we launched last year, and we're getting even deeper with those locations. So instead of a check, we give them space, and between 5 and 10% of the revenue that we contract over the years, and we run about somewhere between a 3 to 5 year contract. The next 12 months definitely going to be interesting for Motio, certainly rewarding, and look to finish off. I think we've got a really great management team in place this year. As I said, we've seen the expansion into PCYC, about to roll into medical center program with an accelerated sort of program that's going to get us stood up in the next 9 months instead of investing over the next couple of years. we've designed this software and hardware that I just mentioned that helps audiences, brands, the creator software that I mentioned, and that's having a real impact. We've continually increased revenue, profitability, operational efficiency, and cash flow. And look, I think we've demonstrated that we've got the capability of continually scaling our operations, and so we're very excited for where we're at the moment. So in terms of revenue per location, we'll go to revenue per minute for you, Mark, but that pretty much wraps me up, I think.
Thanks, Adam. Yeah, a bit like the capital raise. The questions have been coming in thick and fast here. So hopefully we can get through them all. Um, let's tackle the first one. How do we think about specific addressable market size for Motio, whether it's in terms of uh, quantity in terms of revenue size or number of screens, maybe just I know you've talked before at some of our other presentations, you're on the board of the outdoor advertising kind of industry group or whatever, so maybe you've got an overall kind of um rough kind of target market or addressable market for Motio's business.
There's a lot of opportunities for us to go into different verticals. Right now, we're really focusing on the verticals that we can invest in that are going to give us a return. So there's about 6,000 medical practices, for example, in Australia. We're in 520. We've got a really strong pipeline of another 100 with another 100 to come. So we think we can roll into another 150 to 200 and get a linear return on that revenue per location. Cafes, there's lots of cafes out there, but we're being quite specific. There's probably another couple of hundred cafes that we'd like to be in, but we need to grow into that revenue again, like a child would grow into their shoe. The venue space is getting very interesting, very hot. We're working with a number of groups to help those groups market to their own customers. Pubs tend to be a bit of a sophisticated business, but there's literally 7,000 licensed venues in Australia. We're in 150 of them. So, there's a lot of opportunity there. And the indoor sporting environment has been really good. And I think we've sort of made our move this year. We're going to, again, keep growing into that space. But we're a very small end of the out-of-home market, which is about 1.3 billion, which is everything from billboards to shopping centres to street furniture to gyms, office towers, and our businesses. So it's an exciting place to be. The industry itself is growing. We tend to sort of have a foot in both camps of the out-of-home industry, but also in the digital marketing environment. So that sort of allows us to play in a hybrid sort of note, which gives us a very strong and wide addressable market.
And next question is in terms of forward revenue visibility, what do you have? And then if any, and then does it differ between, the big national guys, Macca's, Big W, who are planning, kind of months in advance versus those more like localized, whether that's on a state basis or like really just community based, like, when you mash it all
Yeah.
together, where does it kind of fall out generally?
It's a great question, actually. So because we work on a campaign basis as opposed to like a software as a service, which is different, sometimes we can get, like, we got a campaign yesterday that we got booked yesterday morning and started at lunchtime yesterday. So we had no visibility on that except for the pipeline that we've got. So we run a very tight pipeline in our sales engine, which is about as good a visibility as I'm going to get. So we don't necessarily have that sort of longer term view of revenue out front, but we do have metrics that we obviously stick to. National or big brand advertisers tend to buy lots of our network for a very short period of time. Direct advertisers tend to buy a little bit longer and more of the network. The local advertisers will buy one or two locations, but buy it for a year. So we do get a bit more visibility there. And programmatic, we don't really find out what's happened until the end of the week. So it's a mismatch of opportunities to sort of view revenue out the front, but we do sort of get a general metrics to go, how are we going up, down, or on? But it's not quite as even as say a software business.
Just one back to the unit economics one. how does your leases slash rental relationships differ in terms of fixed or variable rent at the locations, or is it a percentage of revenue? Maybe just touch on that.
They're almost all variable rent or revenue share. They're not even rent, they're revenue share. We do have a couple that we go, yeah, we'll make sure that you get paid that if they're a larger group or what have you, but it's still a combination of revenue share. It tends to be between 5 and 15% of the revenue that we develop for that location. And the contracts tend to sort of go between 36 and 60 months, depending. So a cafe, for example, would be more like 36 months. A medical center would be more like 5 years.
Okay. And then revenue composition by end advertiser, is there particular, brands or industries that tend to, you mentioned the three kind of cohorts of customers that, actually see the screens, the back solving that into then who are the advertisers that are targeting one or all of those kind of three main groups?
Yeah, I'm not sure I really Are you saying of the three main groups, which is the best ones, or
No,
are you
no,
wanting
I'm
them
saying the,
with
the question
revenue?
is, the advertisers particularly that, work with you, for example, is it, more in the retailing space, more in the healthcare space, more in the like travel
Yeah,
leisure
well,
space?
so look, the medical centers make up 50% of our revenue. The total revenue for all of the networks, about 65% of it comes from national advertising. So that's the majority of the work. If I include programmatic and direct in that goes up to 82%. So that's that's the majority of the work that we're doing. The types of advertisers that we get in medical centers, for example, would be, pharmaceutical, aged care, government, medical devices, anybody that's sort of in that health and wellness moment that are wanting to connect with people that maybe aren't in that sort of flow of social media, as an example. In the cafes, it's more like small business, travel, post-grad education is a big one. In the pubs, to be wagering, entertainment, government, so we call it the sinners, the savers, the entertainers. And in the indoor sporting environments, it tends to be sort of the regular, I would say sport-based advertising, government advertising, like we get a lot of gaming and entertainment, like movies and the next game that's coming out. So it's very much youth-based advertising that we get in those sectors.
Yeah. And then just a question on the capital from the capital raise. I know some of it's going to the vendor financing and the rest is, to kind of speed up the rollout. Is that more focused on filling in gaps on a geographic basis, or is it more about filling up, we actually want to have more in that cafe space, obviously very targeted, or is it more to build out the sports center vertical?
So specifically in the capital raise, we've got a really strong pipeline of medical center locations. We know that we can actually take that out on a linear basis. So we think we can maintain, we add 100, we can get a full flow through of that revenue as they come online. So we've made a commitment to wanting to do that a lot faster. It made sense for us to go to market, do a capital raise so we could accelerate our position into that market and realize that revenue. So that, other than that, it's business as usual.
Okay, great. And there's so many questions there. I just want to make sure we've covered them all off. I'll ask this one in a different way, maybe.
Sorry if I've not understood.
No, 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 no. In terms of, if we look out, obviously you've been with the business, I think, was it just before COVID, 2019 you started, I think, was it?
Yeah, late
Or early
2019.
2020, somewhere
Yeah.
around there. But, if we look out,
Motio itself really didn't kick off till the middle of 2010, right in the centrifuge of COVID.
Yeah. Okay. So if we take another 5 year view from now, obviously, a lot of work has gone on in terms of getting the business right, and the sports exit with Michael has happened, and a lot of work has been done, and now it feels like you're like really set up for like growth mode and driving the business forward, and kind of charting a bit of your own destiny. So if we take a kind of a 3 to 5 year view, where do you see Motio if we're now sitting here in 2030
2030.
or
Funny you
2028?
should
We
say
can we
that.
can pull it back a bit if you want.
No, that's fine. Oh, look, I think we're working on the next 3 years, right? So we're like, how do we turn this business into a $30 million business in the next 3 years? Is that ambitious? No, I don't think so. I think we can do that. I think there's some really good organic plays that we're making. So extension of our current network, which is sort of stage one. What are the other verticals that we can go into without really having to add anything to the business aside of a couple of salespeople, for example? And then what acquisitive opportunities are there for us to consider that we can actually, bite off and chew and kind of be accretive to the business? So there's sort of the three things that we're always looking at. I know it seems a little bit basic, but I think we've got into this sort of how we accelerate our medical center business right now, which is going to happen over the next 9 months, which is exciting. And we're already working on some of the other verticals, which we've signaled in the last sort of 12 months anyway. But we're just trying to bite off as much as we can before
Okay.
we can't chew anymore.
Okay. Adam, we leave it there. I will just note as well that we have Adam on here on a regular basis, so I'm sure we'll have him back in sometime in the near future, maybe early to 2026. Adam, for today, we'll leave it there. Thank you very much for joining us.
Thank you. Thanks so much, Mark. Appreciate it.
And we will now hand over to our second presenter. I know he's been waiting there patiently in the background. Bruce Coombes from Quickfee. Bruce, good afternoon.
Hi, good afternoon, Mark. How are you? It's been a little while since
Very,
I've done one of these,
it's
so good to
Bruce.
be
It
here.
has been a while. Good to see you.
Yep.
If you want to bring up your slide deck, Bruce, I will let you know once it comes through. Yeah, it's just loading now, Bruce. Yeah, I can see the cover slide now, Bruce. You can take it away whenever you're ready.
Okay, look, thanks very much. Thanks, Mark. Thanks everybody for coming along and giving a little bit of your time to the Quickfee story. For those of you who don't know me, I'm Bruce Coombes, the CEO at Quickfee and also the founder. So it's great to be here sharing a little bit about our story. Particularly, I'm going to focus on what the future looks like. Quickfee's been a listed company since 2019. So I'm going to take you through a little bit of what we do for those that don't know. For those that do know, you'll see it's a significant simplification of our business and our complete focus on the highest margin product we've ever had, which is our finance product. So we lend money to the clients of accounting firms and law firms so that the firm gets paid on time and the client gets the opportunity to pay over time. So we call the product pay over time, not particularly imaginative. 3, 6, 9, or 12 months is the most common term. So what we're doing is accelerating cash flow for an accounting firm, and that could be a big four firm, right down to a two-partner firm in Australia and in the United States. That is the main part of our business. Around a third of our business is lending money to enable people that have got a personal injury claim or lawsuit to fund what are called disbursements. So if you imagine somebody that has suffered some sort of accident, negligence, personal injury, whether it's a motor vehicle accident, a slip and fall in a shopping centre, any of those range of things, for their lawyer to pursue that matter they need to have a certain amount of supporting medical opinions, data that proves they weren't injured before the event, data that shows the extent of their injury, the extent of their loss. So this fits in with our overall mandate to help accountants and lawyers be paid faster, with the disbursement funding product now representing a third of our business. This is a part of our business which has grown a bit over the last 3 years in particular. On the left-hand side of the screen, the 650 number is the number of firms which have one or more clients currently in the process of being funded by us. Since we started this business, we funded over $700 million. These are unsecured loans. What makes the credit quality of these loans so high is that we have an arrangement whereby the professional firm we have paid must make Quickfee whole in the event their client doesn't pay. So in a professional fee funding, we might lend $20,000 to somebody to pay for their annual tax returns or whatever. Should that borrower fail to pay, which happens quite rarely, but should it happen, the relevant firm that we paid must make Quickfee whole. So we're essentially doing small to medium business lending against the strength of international and national brands and smaller quality accounting and law firms. In the same way with disbursement funding, if somebody is injured, we will provide the funding for those hard costs, nothing in relation to professional fees of the firm, which are typically done on a no-win, no-pay basis. If the client's successful, then we'll be paid out of their settlement. If the matter is unsuccessful, we'll be paid by the law firm. So we are doing very low-risk B2B lending against the strength of quality firms. These are our numbers for the last quarter. I'm going to focus on the continuing part of our business. So the first row with numbers, the US finance pay over time business. $600,000 of revenue in the first quarter of this financial year. So that's about $1 million Australian dollars. The next row is part of a business which we have now sold, and I'll share full details of that on the next slide. So the top row, we've got 600,000 US for one quarter, about $1 million. The Australian finance business, $3 million for that quarter. So the sum of those two numbers in Australian dollars is $4 million. So over a year, you can expect revenue to be around $16 million in the continuing business. And as you can see at the bottom of the slide, we are reaffirming the guidance that we gave in our last market update at between $3.75 and $4.25 million earnings before tax, depreciation, and amortization. Of course, as a finance company, for interest, is of course part of our overall cost of operations. The total transaction values are shown on the screen. In Australia, we operate a payments business as well. That payments business is designed to expose our finance product to more clients of accountants and lawyers. It's not a revenue generator in any net sense on its own. It is instead a way to expose our finance product to the maximum number of potential borrowers. In the United States, we had a payments business and a software business. They were producers of revenue in that market. We sold those two businesses, what we call our Pay Now, so ACH, which is the US equivalent to EFT, credit card and software, a piece of software called Connect. We sold that to our most direct competitor, a company called IWYN, AIWYN. That happened in early September. IWYN is a very well-resourced private equity-backed business, primarily owned by KKR. And they paid us $26.35 million US, so about 40 million Australian dollars for that business. Importantly, through that transaction, we retained the high margin US lending business and appointed Iwan as our exclusive reseller of our finance product in the accountants vertical in the United States. Combined with the Quickfee customers Iwan acquired and the customers they already had, this would represent around 300 of the top 500 accounting firms in the United States, and now within the Iwan group of customers, around half of which are yet to be exposed to the Quickfee finance product. And that is what we are working with Iwan to do, to assist them in achieving the maximum results under their reseller agreement. So now in the United States, we do just one thing: lend money to the clients of accounting and law firms, so the firm gets paid on time and the client gets time to pay over time. As you can see, the US finance business is smaller than the Australian business. This is a function of a previous focus on the significant revenues that were being earned from the Pay Now and software business that have now been sold. It also means a significant reduction in headcount, because we are now literally managing a group of customers we already have and onboarding customers from Iwan. No development spend, no significant back of house, account executives, salespeople, marketing, etc. That's passed to Iwan. So we now enjoy an instantly profitable US business doing what we have always done from the first day we started Quickfee. We started in Australia 15 years ago, in the US about 9. The Australian business, as you can see here, continues to grow. The Australian business enjoys significant margins after payment of interest to our senior lender, has a strong revenue yield across both disbursement funding and also our core fee funding product. The Australian business comprises around 35% in disbursement funding, and across our entire book, there's probably about 40 to 45%, which is legal, and the rest is accountants. There is a little bit of other verticals, but they are far and away the vast majority of our business, and our Australian business continues to grow and has always been focused on lending to clients of accounting and law firms. So we have a business where all we do is lend money. 95% of the principal we advance is funded by our senior lender, so the return on equity is high. Following the sale of our US business, shareholders will be asked to vote on a resolution at the AGM on 18 November to return 7.5 cents per share to shareholders. Should that resolution be passed, and it's highly likely, then the capital return will occur on the 1st of December 2025. $28.4 million of cash passing from Quickfee to its shareholders. From the sale, there is a certain amount of escrowed proceeds which are to be released in different stages over up to 36 months. That will represent additional surplus cash for Quickfee. As you can see, the balance sheet is now very strong. We have a new debt facility from Viola, 68 million of which is committed, with an accordion to take it up by a further $50 million. 46 million is currently drawn. Matures in June 28, and as you can see, a strong net interest margin from what we collect in interest from our customers and what we pay to Viola. As we work our way through the collection of the escrow proceeds and the earning of profits, we will work to develop an appropriate capital management strategy to ensure that shareholders benefit from continuing positive operating cash flow. Which brings me to, what does the balance sheet of Quickfee look like? At the market close on the 27th of October, at 11.5 cents per share, the market capitalisation of Quickfee was $43.5 million. In the unaudited financial statements at 30 September 2025, the net assets of the company were $42 million. We reaffirm our guidance at between $3.75 and $4.25 million of earnings before tax, depreciation, and amortization for financial 26. And in the chart on the right-hand side, you can see the sum of the cash plus book value of the receivables and cash of the company, $47 million. So looking forward, we're doing one thing: lending money. We're doing that in a very low-risk way by having that money backed by significant quality accounting and law firms. Our experience in Australia is being leveraged in the United States into this singular focus. Iwan are our exclusive distributor in the accountants market and are an extraordinarily well-backed professional organisation motivated to add this solution into their overall technology and payment stack, grow their business, and in so doing, grow ours. We don't have to spend money on product development. We are not building software. We have a 95% loan-to-value ratio from our senior lender. We don't need significant amounts of capital, as we did before when we built out the business, which was ultimately sold for 40 million Australian. I'm more than happy to take any questions, and I really appreciate everybody taking the time to listen to the Quickfee future story.
Thanks, Bruce. Bruce, can you just go back one, or maybe just keep the slides up there? I was going to say, sorry.
Yep, it's fine. It's fine.
Just in case you want to maybe reference something, it's easy to flip back, but maybe just go back one from the disclaimer. Just for I saw Simon's email address there somewhere. I was going to say leave it on that slide if anybody wants to. And Katie's, just in case if we don't get through all the questions or people want to reach out with more questions, they've got time to take this down. One of the questions is around, obviously, Quickfee looks undervalued according to this investor, but just considerations, I think, around, landing on the capital return as opposed to, another capital management initiative of, doing a buyback or just declaring a dividend. Maybe just talk through how the capital return came into being and what dividends, buybacks might look like in the future as things have evolved now with the balance sheet and the way the business is set up moving forward, as you alluded to in the presentation.
Absolutely, Mike. So as you'd imagine, the board looked at a range of strategies such as share buyback, selective share buyback. If we were to pay a dividend, it would be an unfranked dividend. We had accumulated tax losses from the development of the platform that we sold to Iwan, which means those losses have been substantially utilised now against the sale proceeds. So therefore, we wanted to do something which would give exactly the same proportionate return to every shareholder. And that, of course, was a return of capital. So that's why we set on that for this round. Into the future, I think if we're in a position where we're paying Australian income tax, then franked dividends start to emerge as a much more likely scenario for shareholders going forward.
Okay. And then the next one, and it probably follows on from that, people just talking about the, liquidity in the share not being maybe as high as they would want to. But I guess, when if you're doing dividends at some point in the future, then DRPs can come into it. Maybe just. Is there anything else you can kind of do on the liquidity side, or thoughts on, maybe the board of trying to improve it or address it on let's say a 3-year view maybe?
Around, look, there's probably 50% of the company which is in the hands of the top 7 shareholders, including myself and my co-founder, Dale Smorgan's family, Thorny, etc. So little happen in terms of liquidity in terms of that top 7 shareholders. In terms of the rest of it, I think we've now got a story where it's clear that we're reaffirming our guidance, that we've got positive cash flow, we've got a profitable business, an extraordinarily simple business. I think paying dividends, doing whatever might occur in terms of appropriate capital management should improve liquidity. We are doing this presentation, Mark. It's the first one of these I've done for a long time, partly to address that question from some of our retail investors that do want to see liquidity. And one of the best ways to do that is get our story out there, particularly now the story is so simple.
Yeah. Another question we have here, interesting one actually. The depreciation and amortization profile of the group now that the US business has been sold. I know you mentioned, there's no development of software, but in terms of writing down what has been spent, does that get accelerated now, or is it kind of comes out in the wash with the sale?
Okay. The amount of development cost that was actually capitalized was less than $1 million. So everything we were spending on that was going through the P&L, and that's part of the explanation behind the accumulated losses up to the date of sale. So there is no material DA beyond, maybe a couple of dozen laptops or whatever in terms of depreciation and amortization in this business. The software we use to run our lending business is leased from a significant SaaS platform provider. So we literally have minimal development. I'm talking less than $100,000 a year in a big spend year.
Okay. And then I just wanted to touch on, the 700 clients that you talked about, in terms of vetting a client, where should people think of like a typical customer for Quickfee? I'm assuming it's not, a suburban accountant in Sydney or Melbourne, who's like a one-man band, just doing kind of mainly tax returns and a bit of small business. Where in terms of if you're doing your own due diligence on a firm to like onboard them, what's the kind of revenue, and maybe we touch on the legal side as well. Do they have to be turning over $1 million a year or $5 million a year? Maybe just that break point of, who is the target customers?
The typical minimum size is a firm with $1 million of revenue, demonstrable profits. The typical firm is 3 partners and above. So our largest customer in Australia is one of the big 4. Our largest customer in the United States is one of the big 7. We then go down from there. We would probably have around 60% of the top 100 accounting firms in Australia using Quickfee. So the vast majority of our business are brands you would know, but it drops down to 2 and 3 partner firms, but very, very rarely below $1 million. In terms of law firms, we do have some national law firms, but the middle part of the law firm market is much larger than it is in the accounting firm market. So we have quite a number of large, but not necessarily extraordinarily well-known brands, particularly outside of their relevant city. But we don't deal with firms that are not for example, up to date with their BAS, their income tax, all those sort of things. These are all things we check through our credit review. The borrowers are typically, nearly always, some sort of SME, very rarely listed, even a small listed. They tend to be owner-operated businesses, where that owner is running a $500 million business or a $5 million business. They're clients of a quality accounting or law firm.
And then in terms of, I know it was on one of the slides there, IWIN are going to be doing the customer reach out for you on behalf of, I think you said accounting. Does that mean you're going to be managing the legal reach out for new business, or are they also going to be doing legal for you as well in the US?
We will do legal ourselves, and they will
Okay.
do accounting only. Their exclusivity extends only to accounting. Their products are only sold to accounting firms.
Okay. And then maybe just a comment on, where you think or the prospects for growth on the legal side in the US business. That pipeline, obviously IWIN have a huge pipeline, that they can immediately tap into, but in terms of trying to grow the US business at the back of your own bat, maybe.
Yep. So, we will focus on legal in terms of our own customer acquisition. The legal market in Australia is, frankly, easier for this product to be sold into than it is in the United States. The legal system in the United States allows the taking of contingency fees, like you see in the movies, they take 40% of the settlement or whatever. That is not permitted in Australia. So the model in the US is actually much more profitable, but much more contingent. Whereas here in Australia, we follow the UK legal system, which is basically you can only recover your hourly rate or a small uplift if you choose to defer settlement. So that's why our product works so much better here than it does in the US. So we would have less than 5% of our business in the United States and greater than 40% of our business here in Australia, including DF, is lawyers.
And in terms of which just focus on the Australian business, I'm just trying to get a sense of how fast the market is growing, just in terms of obviously all these accountants and lawyers or whatever, they're looking at their fees on an annual basis. Plus, you have growth in the economy. So I'm just trying to think, when they put up their prices, obviously that's good for Quickfee because now it increases the annual bill. But what is that kind of growing at? Are they raising fees? And just with everything that's going on in inflation in the last, let's say, post-COVID period, are they kind of keeping up with inflation, and it's, a 3 to 5% price increase they're pushing down onto their customers, which obviously, in a second derivative way actually helps Quickfee.
Yep. Legal and accounting will be growing faster than inflation in terms of their actual pricing, the fees. The thing that's more likely to drive it, Mark, is Quickfee has a bit of a counter-cyclical element. So as the economy slows, there's greater demand for advice, not tax returns, but advice from your accountant, and less capacity to pay for it. So there's a counter-cyclical element to Quickfee. There is also, we're seeing growth in our business because of our Xero integration. We integrate, most people would know Xero, XERO, the well-known listed accounting platform success story. We integrate with Xero. So as more and more accounting firms move online and start to use Xero as their invoicing engine for their business, we see more and more firms taking up our integration option. The power of our integration option is that for a cohort of firms which were Quickfee customers before integration, compared to 12 months after, we see the lending of those firms double. So that is a significant driver of growth in our business. Think of it in another finance company, you would call it embedded finance. That's what that's achieving.
Okay. And then last one, we'll just squeeze it in here because we're just coming up on time. Just on the net interest margin, as you kind of grow and as the balance sheet now is, completely changed from, even 6 months ago. Is there capacity, do you think, as refinancing comes up, or bringing on other lenders for the NIM to expand positively?
There is. It's important for us to get through this next sort of 12, 18 months. We've just got our new facility in Viola, which is on far superior terms to what we had before, particularly in terms of the loan to value ratio we now have, which is 95%, much higher than we had before. So we have a much better return on equity and a lower average cost of funds. It is likely the next major milestone is a $100 million book. And at that point, you open up another different tier of lenders.
Okay. Something to watch out for. Bruce, great to have you back with us. It's been a couple of years, so it's good to see you again. And hopefully we can touch base sometime in 26. If I can ask you to please stop sharing your screen, and I will hand over to our next presenter, Professor Subhash Challa. He is waiting for us here patiently. Subhash, if you want to add
Hi there. Can you guys hear me?
we can hear
Thanks,
you,
everybody.
Subhash. Yes, thanks, Bruce. Yeah, it's just loading now, Subhash. Yeah, I can see the cover slide of the AGM deck now, so you can take it away whenever you're ready.
Okay, thank you. We just had an AGM 2 days ago, so I'm using the same presentation, so that's why the slides are that. Thanks for the opportunity to present here. So I'd like to introduce SenSen. I'm the founder and CEO of the company. I'm Subhash Challa, and we're headquartered in Melbourne. We have offices in Singapore, India, and Canada, and US. We basically focus on how to deliver remote compliance and curb management for cities and governments. Our customers are mainly city councils, municipalities, police and enforcement authorities. And we have developed AI-powered solutions using cameras and sensors to monitor the footpath and the curb, and deal with enforcement, which is predominantly manually done prior to SenSen coming to life. Even today, you see officers walking with belt-mounted printers, or with a handheld and taking photos and chalking tires and things like that. We found a way to completely automate that process, and now we are growing globally in that space. So we are an Australian company, spreading our wings everywhere. So as I said, we have customers in Australia and New Zealand, US and Canada, and Singapore predominantly. First, I'll touch on how our FY25 ended, and then touch a bit on what we're doing, what we did in the first quarter. So we had a stellar year. We grew 26.5% in revenue. Our gross margins up 38.3%. Our EBITDA is 1.7 million. Without share-based payments, it is 3.1 million. This is the first year where we turned completely profitable. We have been showing the trend of profitability for a good 2 years before this, and we started working towards it, but we crossed over in the last financial year. We pretty much removed all debt on the books. Whatever was there, we have only one debt remaining from Rocking Horse, which will be repaid as soon as we get the R&D tax refund. We grew 41% in revenue in North America last year, and it's a significant momentum there. We won City of Montreal, in an open tender. And we also had a tender where we won City of Calgary, who was our client earlier, but they extended the contract by re-awarding it to us for another 9 years. Our OPEX has reduced by 1.3 million. We are able to get economies of scale in our supply chain, increasing our gross margins as well to drive profitability. We are big in innovation for a long time, and we continue to do those kind of innovations. So we have recently introduced a technology for rapid deployment that can go and attach themselves or insert into the poles that are there on the footpath where you see parking regulations, and they can monitor the activity in and around it for safety and compliance. This is just a pictorial view of the snapshot of FY25, but it also shows a bit on the trend. So 23 was 10.7 million, 24, 12, 25 is 15.3. Gross profits again, continues to grow. So this year was 12.14, came on the back of 8.7 and 7.4 before that. Operating cash flow turned again from negative to positive. EBITDA turned from negative to positive. So that's a strong recovery story on how we are progressing. Now coming to this quarter that just finished, we continued our performance, stellar performance that we have established. We grew 27% again in cash receipts. It's a record quarter for Q1 and overall as well. And you can see the trend. It's not like one trick, something is happening to deliver a great result. It's a trend. We are growing year on year on the back of strong products and strong product market fit and high margins. So what do we actually do? What is the core IP of SenSen, right? So our core IP is Sendisa, which you can see in the middle. Is SenSen's distributed intelligent sensor analytics platform. It's a multi-sensor data fusion platform. What it does, it takes data from sensors. It could be cameras, GPS, radar, LiDAR, any streams coming from drones. We have a software stack which can inject data from these sensors, and we can drive business applications for different use cases. In order to do this, we fuse the data coming from here with enterprise system data, and this fusion is our IP. Okay, so Sendisa uses AI to analyze and fuse sensor data feeds from the physical world to detect and track objects of interest and combine it with enterprise digital data in real time. And this is a generic capability, so we could solve many, many problems with that. At one time, we were in casinos, we were in airports, seaports, doing different high-value use cases. But our dominant focus now is in city councils and curb management, because that's where we found our product market fit. It's a global problem. And if you think about the scale of the problem, you're talking about tens of thousands of cities, and each city has tens of thousands of kilometers of curb. And it doesn't matter how many people you put there, you just can't cover it with humans. And when cities are getting crowded, you can build towers and build multi-floor towers, but you can't increase the curb space. So that's limited. So it's getting congested and competition. So regulation has to be there to kind of use it in an equitable manner. And the way people do it is by using offices before SenSen. And SenSen has come in to automate that process by using, for example, vehicle-mounted camera systems or pole cameras or other kind of CCTV cameras, and they marry with the vehicle database or payment or permit databases, zone maps. This is the enterprise systems from the council. When you marry these two, you can create real-time alerts on compliance and non-compliance, and you automate the workflow of the officers. So similar thing applies in road safety as well, where you can use drones or trailer-mounted cameras or other things. We are completely camera agnostic. We can use any vendor cameras, any vendor systems. We focus on software and we deliver the solution for the customer. So in terms of the business overview, as I said, it's a very large and growing market, 10,000 cities times thousands of kilometers of curb to manage. We help the cities to regulate and monetize this curb. We reduce congestion on roads. We increase safety. Current competitor systems are either manual or partial automation, and they don't solve the full problem. So solution is to fuse data feeds from cameras and sensors with city digital data sources. And SenSen's AI-powered software and agentic AI software automates this enforcement workflows. And the customer value is really improve productivity and safety of enforcement officers, empower cities to monitor and monetize the curb space efficiently, and we create irrefutable digital evidence to support their operations. Many times our photos and images are used in court and to prove compliance or not, and we never really had a rejection so far. Revenue and growth. Basically, we have three pieces in our revenue. There's a little bit of hardware and project commissioning where we need to set up the council to go to this new way of doing things. That's upfront money. Then we have a software license fee that is they have to pay for cloud and all the back office and the integrations that we do with third-party systems and a user interface they use to do the workflow. And finally, we take a clip of the revenue from the council's ticket revenue. So we have this three-piece component. In Australia, we do all three. In Singapore, for example, we take upfront and recurrent revenue for the back office software. In US and Canada, it's a mix of both models. We grow through new city wins, and we also upsell to existing customers. So typically, the amazing story we are now landed is every city first starts off, they get a contract, they set up our system, they might enforce the curb of, let's say, 10 kilometers or 20 kilometers, but they have hundreds of kilometers to cover. So over time, they keep adding more systems or more automation, and that's how we grow revenue from existing cities. And new cities are adding, which start again, and revenue grows that way. So new city wins and existing city upsells continue to propel our growth in a very strong manner. So this is just a summary of all the things. We're currently in 60 plus cities globally. In 2017, we got listed, and at that time, we probably had like 5 to 10 cities. And today we are in 65 odd cities globally. This is a snapshot of our revenue and what has happened. I think we already went through these numbers. Clearly, the jump was from 12 million to 15.3, and you can see a EBITDA excluding this. Even NPAT is profitable, so we kind of turned the company completely around. This is the regional view of the growth, and you can see that North America, which is the green, grew from a modest level to very high. ANZ is looking flat, but it is mainly because we exited gaming and we lost $1.5 million revenue from that, and we focused double down on smart cities. So we recovered pretty much whatever we lost from that exit, and we strongly believe this will grow next year very strongly. Cash and debt management, as a summary, as I said, we pretty much removed all debt in the company. We still hold some facilities, but we're looking to close some of those. And the only debt facility that is there is Rocking Horse, which we will pay out when we get the R&D tax return. So in summary, why invest in SenSen? Why are we interesting? We're a globally scalable business. It's an Australian company expanding and exporting globally. We are rapidly growing. We are a recurrent software as a service revenue model with a variable ticket revenue that comes on top of the normal size. Customers continuously increase the length of curb they are automating using SenSen. That gives a constant feed of additional revenue we get. That's why our net retention rate is greater than 100 because existing customers are ordering more and more. Each deployment increases economies of scale. So it's allowing us to optimize our supply chain and so on. So what's our competitive moat? Why are we so strong and why would we remain strong? Because it's not just about AI or some cool technology. We are deeply integrated into city workflows. So we have really low churn, almost zero in the last 5 years. We didn't lose many customers, any customer for that matter, in the city space. Because switching costs are very high, and we are also innovating at a rapid pace than our competition. We have entrenched domain expertise. We understand the problem we are solving and how the product we have introduced makes more money for our customers, reduce costs for the customers, and increases the KPIs for the city on how fast the traffic moves and how safe are the roads. The customers are blue chip and global customers, and based in Australia, Singapore, and US and Canada. Another very important thing that's not easily understood, but we are trying to emphasize, is a lifetime value of our customers is very, very high. Brisbane started as a customer in 2016. They just extended the contract for another 4 years. So that's already 14 years, lifetime for Brisbane alone, and I don't believe they will be able to leave us that easily. Calgary, same thing. We won them in 2015, 16, and we just re-won the contract to another 9 years. Singapore, 2013, now they've just extended for a few more years, and it's 14 years plus. So this is not a story of just one or two customers. Pretty much all customers, once they come in, it's extremely hard to move out of the kind of solutions we're giving, because it adds revenue, it reduces costs, and it's very hard to switch from one vendor to another in this space. We also created credible reference base with deployments in 60 plus cities in 4 continents. So we are winning more and more tenders because our references are great, and people are able to go and see our products before even they go to tender in other cities locally, so that they are familiar with what they're buying and they can compare with other competitor products. Our technology depth is significant. We have 15 plus years of R&D investment. I started off as a professor in computer systems and few patents, and then few students of mine came out, and then we formed this company. And my first ever staff who was a student became a CTO. So it's a long history of deep technical knowledge, and we kept building on top. We kept up with the AI advances, and we have the latest and greatest tech stack that's embedded into our AI live awareness platform. So to close off, our unique proposition is that our solutions are holistic and integrated into city workflows, brings in a unique value from physical world sensing, what's happening on the road, what's happening at a facility where vehicles, people or objects are involved, and computer vision and sensors convert that data and marry that with enterprise system to deliver end-to-end automation. Our competitors are point solutions delivering incremental enhancements and very limited automation. So that's kind of why we are winning. If you look at startups coming up with amazing technology, there's always a new invention every day. That's all great, but the startups do not fit the risk profile of government customers. So often, startups backed by venture capitalists can't survive the delays that usually happen with government customers. So we have seen many companies come in, try to do something, they couldn't wait long enough, they die. This happens all the time in industry. We have survived that. We were a startup long time ago, but somehow we found our way. We waited a good long time to get where we are. So we kind of over that situation. The legacy companies or the grown-ups or scale-ups in this business are busy holding on to their existing revenue streams and not disrupting themselves to offer new age AI-powered automation tools. So these companies are becoming our partners. For example, in winning some tenders where forward-thinking CEOs of some of these old companies are taking our products to go to market in places like US and Canada, where channels are helping us win customers. In Australia, we kind of do a lot of them directly, where we win going head to head with some larger companies, but we have won tenders along with partners as well. So SenSen with the proven global capability to deliver scale is, I believe, best positioned to serve the demand, and we expect to dominate the market. So I'll stop here and take any questions.
Thanks, Subhash. Maybe we'll kind of finish off, or sorry, start where you finished off, and maybe just, I know you were, I'm not sure if you're still there, based in the US for a while, really getting the US business and the Canadian business firing on all cylinders. In terms of given it the jump that we saw last year in, the growth in the US business, pipeline in that market, obviously Calgary re-signing, but in terms of getting, new cities on board, or expansions of Ks in other cities, or miles, I should say, on their side.
Yep. Absolutely. I mean, Montreal is a new city we won last year. It's probably and also one of the largest contracts that we announced, up to $17 million in there, and they could potentially put our system on over 100 vehicles. They only released the purchase order under the contract for 13 vehicles, which you have delivered. Now they're using it. It's up to $4 million on that initial order for the upfront and recurrent, maintenance and SaaS revenue. And we expect some additional systems to be ordered under that already. In the last 2.5 to 3 years, I would say 2.5 years, I would say, we've grown from 2 cities in Australia, 2 in US and 2 in Canada, to about 20 cities now in North America. Okay, so we are in Vancouver, we are in Toronto, we are in many smaller cities in in and around Canada, and we are also in about 8 cities in US, smaller ones, and bigger ones are coming along the way. Recently announced Philadelphia. We are in Palm Beach, Florida. In this year, we won it. So that momentum is picked up, and we expect it to continue to grow.
And in terms of the revenue models, are you agnostic? Do you kind of offer all three of them, and the specific city or council takes them, whichever one they want, whether it's a percentage of revenue or not, or is it more market specific, just the way that market is? It works in Australia, but it mightn't work in Canada, for example.
Yes, it is. Sometimes it's education also. Even in Australia, people told me you can't do ticket revenue share, but the kind of IP that we developed and the value we created, nobody else has been able to do it. So we were able to negotiate those things, and now it has become the standard in Australia. We don't do any other way in Australia. We go with the same model, but in US and Canada, it's starting to happen. There are a few cities who have woken up and said, okay, we want all those features. Nobody else can give it. You are able to give it, and it's money that nobody's picking on the street. If you are helping us, then they go along with that. Obviously, we have to be flexible in order to get our minimum critical mass in the cities we are in. So we were flexible in the early days. We work on educating the client, educating the partners, and then try to move the model more to our preferred model. But even if it's not, then we do make still significant recurrent revenue from the recurrent license and maintenance we get from the cities. It's more about customers experiencing the product and how easy it is to use and how much value it is adding. Then it becomes easier to introduce additional revenue, generating features to them. Yeah.
And in terms of expansions, you kind of 4 countries or 4 geographies listed there, and I mean, obviously the US, there's still huge scope to grow that. But in terms of strategy of moving to another geography, is the UK or Japan or France on your growth strategy, or is it more if somebody approaches us from another geography, we'll definitely look at it, but we're just going to focus on the 4 geographies we're in now, given we can point to local deployments, local success stories, local customers, and it's kind of a much more kind of easier sell than trying to crack those, as you said, that like critical mass of the first maybe 5 to 10 cities in a completely new country.
Currently, it's a lot of growth untapped in Australia Singapore, US, and Canada. And we can only eat so much. You can't go everywhere. But so that's definitely the main focus. Main focus is expand more in US and continue to lead and dominate Australia. Having said that, we have some inroads with some trials happening in India and Middle East. We had to go to places where we can execute. And it's very much depending on whether we have the manpower and the right connections and right influence to execute deals within those spaces. But we are not going worldwide, blast right now. We will selectively go into areas, but dominant focus is Australia and North America, with a bit of excitement going on in India and Middle East. Yeah.
Yeah. And in terms of margins between, if we take the US and Australia, you spoke about, you've got a few channel partners in the US, whereas Australia, it sounds like it's all direct. Maybe just talk to us about, using the channel partners in the US, where it kind of makes sense. I'm sure you're doing your own direct outreach there as well. How that impacts, the kind of final margin that flows back to SenSen.
I mean, usually when you go through a channel partner, you would part with 10 to 20%, 30% maximum revenue. I mean, we have never given any more than 20% to our partners. So it's a sales cost. I mean, you can either have a large sales force or you can have the sales force of your channel partner, and we can go with that way. It doesn't materially impact our gross margins of the deal because it's because the cost of hardware in any of things is like a minuscule portion of the total revenue we make from the customer. So it doesn't materially change our gross margins. But what it does, what it affects is the total revenue we make per customer. We may be parting with a small margin, but they do the level one support, and there is a reason why they get it. And we get faster access to customers if the channel works efficiently. Not to say there are always challenges with channels and everything, but it took some time for us to find a few good channels. We have a lot of success in Singapore, where channels sell very efficiently, and we pretty much do all business through channel partners there. In US, we tried a few, and then we settled on a couple who are doing a good job right now.
And I do want to come back to your slide on lifetime customer value or length. Yeah, that one. In terms of if we're taking on if you're taking on a new seat, whether it be in Australia or the US, what's kind of the initial term, and then if they re-sign, given your experience, do they like re-sign for longer, or is it just replicate the initial terms of the initial term is 3 years for 25Ks, but they might re-sign for 5 years, but increase the Ks up to 100. Maybe kind of give us a sense of that initial renewal and how that affects the trend in terms of long-term customer life or value.
Customers, I mean, even though they might give a initial tender order for, a couple of $100,000 or $500,000 over a 3-year period, even within that period, we usually have terms where they can buy more systems and pay more, okay? Within the initial term itself, and that has happened with pretty much all the customers. They start off, they have provision to order more, they order the initial bit, and then they keep adding more, right? And then maybe in 3 years, 5 years time, depending on our new products and product enhancements and additional features we have, they may include those in the new tender or new extensions and order more. So constantly on a yearly basis, we are account managers, success managers working, constantly increasing the amount of revenue we get from them, because they're buying more system to call more curb or issuing more tickets, whatever that case may be. Yeah.
And in terms of seasonality in the business, obviously Australia, Southern Hemisphere, US, Canada, now the Northern Hemisphere. But in terms of, as you said, issuing tickets there, does that really have a big swing factor, or is it, both halves kind of even out with the, the kind of dual hemisphere revenue lines?
So, I mean, when we were predominantly Australian focused, which we still are, like majority of our revenue comes from Australia, our financial year ends in June, and we tend to get a lot of orders or spending happening just prior to June or just after. So typically we have our final Q4 to be the biggest quarter in general. Okay, of last 5 years, you think 4 out of 5 years would be the last quarter would be your largest quarter, and that trend keeps continuing. And in US, the financial year ends in December. We don't have enough customer to spring it, but hopefully when we get 50 odd customers, just or 100 customers in US, then they will balance out and say some money comes in December because of US, some money will come in June because of Australia, and then might smooth it out. But right now we have that bit of the like last year we did 15.4 million. In the first half we only did 6, so we did 9 in the second half. Okay, if you look at it, right? So we tend to have that behavior, on an ongoing basis. Okay, so we expect that to continue for a bit more, but maybe becomes a lot more, systematic quarters or same type of behavior in quarters over time. But we're not seeing it yet.
Okay. Subhash, we'll leave it there. Thank you very much for joining us once again, and best of luck with everything.
Thank you.
We'll hopefully touch base sometime in 2026.
Okay, great. Thank you.
Thank you. And then we will move on to our final presenter of this afternoon's webinar. Sorry, excuse me. Amos, if you want to share your screen there now that Subhash has taken down his.
Yes, good morning. Good afternoon.
Depending on where you are. Morning for Amos, where he is. Afternoon for all of our attendees in Australia. Amos, once you get your deck, it's just loading now. If you want to go back to the cover slide or the first slide, you're on slide 7. Yeah, there we go. You can take it away whenever you're ready.
Okay, so good to see you again. So I will go over way to that our new strategy, mainly the 4 pillars one. I will go slide by slide, and then I will wait for your questions. So way to that, we are entering to a new strategy that we announced in the last few months. We call it the 4 pillar strategy. So in this strategy, you can see in this nice temple, I will take you from left to right. So in the bottom, we see, it's all about humans. So we have a strong teams running in different countries between Barcelona, Spain, and Tel Aviv in Israel. A very strong R&D team that develop a unique platform with 6, 7 different patents based on AI. Way to that, the baseline is technology. And of course, our existing client, we have about 500 clients today. Going left to right in terms of the pillars. So the first and the most important pillar is the VAT reclaim, VAT GST reclaim. We are doing that in the last few years. Mainly, it's a VAT platform that can reclaim in 40 different countries, 20 languages. The business model, we are approaching just enterprise client, very large one. We are reclaiming 2 types of items, I would say. One is T&E, travel and expense. Clients that are traveling globally and they have expenses with their employees, if it's hotel or any kind of accommodation, transportation, events, hosting clients, restaurants, whatever is there, there is a VAT attached to those invoices and receipts, so we can reclaim it, or we are reclaiming that in very large scale. We are talking about like 1 million invoices monthly So it's a very large number. So this is the T&E. So with the T&E, we divided the travel and expense. We divided it to local. So we do a lot of local VAT GST for T&E for travel expense. Local ones, so those large companies that they have employees traveling in their own countries, like in the UK, with Aviva is the one of the largest insurance companies. So we're doing that in the last few years. We are reclaiming their local VAT for their expenses for the employees in the UK itself. And the foreign is the international one. So I said 40 countries, people are traveling to those countries, mainly in Europe, some in APAC, some in South America. We can reclaim all those T&E expenses to companies. So this is the T&E part. On top of that, we do AP invoices for foreign AP, large invoices, account payable one for VAT and GST. We reclaimed it on very large scale. So clients that they have services that are non-T&E activity, that means advertisement, indoor, outdoor in very large scale, client like MasterCard, they can do that. They are doing that globally. Client like Foot Locker or others that they have a lot of advertisement in Europe or in other countries, fashion companies, retail one, large one. So we are taking all these AP invoices, foreign one, and we are reclaiming that in front of 40 countries. So this is mainly the VAT pillar. Today, the VAT pillar represent, I would say, 90% of our revenue. All the four pillar strategy is based on growth. So I will move to the second pillar, that is the APAI. This is a new product line that we announced shortly. We announced it. Let's say, and we announced it 6 months ago, and we started selling that in Europe in the last a few months. We signed a very large client already with this product. The API is based on AI technology, is account payable, artificial intelligence solution. This product is invoice validation, compliance invoice validation. So any company around the globe, very large one, that they have thousands of invoices monthly in different countries, they can go to our platform online and can check if the invoices are validated or if the invoices are compliant to the law. Potentially, if they are not doing that today, they can lose a lot of VAT or GST to reclaim. The system can, in millisecond, can alert them, tell them if it's green that they can proceed, do the payment for the supplier, and then to reclaim it in front of the tax authority. Red is something that they need to check with the supplier. They can lose the VAT or cannot reclaim it. And when it comes to big companies, can come to very large amount. So therefore, we are providing this solution. And yellow one is something that they need to address it with the supplier to see if there are some items that the supplier need to change in order to reclaim that. So this is a real-time platform providing to the financial teams in large companies to do this process almost online. Today, they are doing like a random check. Time to time, they are checking the large invoices. With that platform, they can check any invoice for any size, in any language, in any country. And this is revolutionary. This is also can avoid issues that they can have in front of tax authorities for auditing issues. Once they are doing that, they really can reduce the risk and they can get more benefits in terms of getting the right VAT to reclaim. And it comes, when it comes to VAT GST, this can come to millions of dollars, sometimes can come to 10 or 100 million for a company yearly. The third pillar, this is a pillar that we said that we don't have it in-house. This is the VAT compliance consultancy that we very much would like to have it in Vat. So therefore, we acquired recently, and we announced it in 1st of October, a new acquisition by Way2Vat. By the way, is the second acquisition that we have done. The first one was Develoiva in Spain. Successfully, we see a nice number from this company in the last 2 years after the acquisition. And RBC VAT is the newcomer. This is the company we acquired just in October. They are providing us this pillar, the VAT consultancy. We've been facing issues with a large client that have a lot of questions when it comes to compliance in different countries, cross-border, sending goods between countries, VAT registration, VAT compliance items. Mostly in those cases, we've been moved them to one of the big four, Ernst & Young, PwC, KPMG, or Deloitte. But now we do that internally. It's a boutique company that we acquired with top 12 consultants that really can provide those services to our clients. It's needed. This will provide us a growth, a profitability, and end-to-end solution with our client. The last pillar is the e-invoicing. E-invoicing is a new regulation, mandatory, comes to in Europe and shortly in different countries as well. Countries decided to avoid fraud because they are losing billions of euro dollars every year because of fraud of invoices. So they want to avoid it, and therefore they came with a new standard that each invoice with different size should go through that online system to get the approval. So we developed that platform. It's part of our end-to-end solution. So this is the four pillar. So let's move pillar by pillar. So the first pillar we discuss is the VAT reclaim. This is our core business today. We have reclaimed in the last 4 years about 125 million Aussie dollar. We are proceeding or processing 1 million invoices per month. We have coverage in 40 different countries. We have about 414 clients in this pillar standalone. We acquired a company in 2022, Develoiva, in Spain for VAT reclaim. So this is a complementary services that we are doing with Way2Vat. So we have presence and also in Spain with that solution. And this pillar based on AI and some patents that we developed in the last few years. Here in this graph, you can see the growth year over year. The blue color present the revenue. So potentially you can see the growth is about, let's say, around 50% in average. And we would like to keep this momentum. The organic growth should stay at that level. So we are talking about $6.5 million Aussie dollar for this year, representing a 45 million VAT reclaim cash in to our clients. So you see the growth from 2022 to 2025. So we almost triple or more our revenue. This is something that we announced today, the revenue for this quarter. So you can see the revenue in Q3 is a record. So we have about 1.9 million Aussie for this quarter, almost 2 million. So we are reaching to 2 million. So you can see the growth quarterly. So again, this quarter compared to same quarter last year, it's about 40% growth. Compared to the last quarter, it's a 35% growth. But in general, we would like to see the growth of about 40-50% year over year. We are keeping that momentum, and this is by only organic growth. This year, based on the number I presented, all the idea and based on technology and all the activity we do, and also the acquisition that we announced a few weeks ago. So all the idea is to move the company to profitability. So it's an inflection point 2025. So we do believe that in 2025, we get the company to break even in terms of P&L. This is a real milestone for the company. On the same time, we are with the four-pillar strategy, we very much would like to increase our total available market. So we are moving for one pillar that it was about $20 billion TAM to about $187 billion total available market. This is a big growth. No ceiling growth here. It's all about execution. So in terms of the H1, I will concentrate just on the H1 25 number. So we are still growing in revenue. So the revenue growth, we are talking about 43% in average. I said we very much would like to see the company in those areas of 40 something up to 50% growth year over year. We have robust growth in account receivable. For this quarter, it will be about 6 million Aussie account receivable open. Potentially, we can, it's a cash in for the company. So we see the growth quarter over quarter. We improve our efficiency. So in average, we cut the budget about 7%. So this is something that we very much would like to keep that momentum, although we are growing. Margin expansion, and this is something that I'm saying all the time. This is one of the uniqueness that we have in our platform, our technology. The gross margin of the company, it's 82%. So it's all about the top line. If the revenue will show the exact growth that we are expecting, so this will take us to profitability in 2026. So gross margin is one of the key, I would say, item in way to that business, and we very much would like to keep that margin in the coming years. In terms of the second pillar, the API, this is a new product. It's by the way, that product is different than others. That the first pillar, the business model was on contingent base, on success fees on fees. Average is about, I would say, 20% fees we are getting from our clients. For API, it's a SaaS fee-based fee product. It's a new one. So we will charging our clients on packages with minimum 500 invoices per package per month for a client, can goes up to 50,000 invoices per month per client. So it's very scalable. And the idea is to validate invoices in terms of compliance in 20 languages. This potentially can support about 179 countries in the world, those countries that they have VAT or GST regulation. So they can check if each invoice is compliant. And then the idea is to do it in very large scale. This is a revolutionary product. There is no solution in the market in that scale today. Mostly clients are doing that, random check here and there, looking for very large invoices. They are not going and are not checking bottom up all invoices. And an idea to do that automatically, clients can upload by batches hundreds of invoices, thousands of invoices, or tens of thousands of invoices, hundreds of thousands of invoices at the same time, and the system can validate it. So this is revolutionary, and this is part of the new strategy that we are presenting in the market. The third pillar is the VAT consultancy and the compliance one. And as said, we said we don't have these services and capabilities inside the company. In the last few years, whenever we had requests from clients, we moved it to one of the big four players. And now we have it in-house. We acquired RBC 1st of October. This really provides us the end-to-end solution for our clients, from VAT reclaim to invoice validation to VAT consultancy and compliance to e-invoicing. So this is the third pillar. M&A in general, way to that announced from day one, we started our journey about 3 years ago in ASX. We said we are looking for acquisition to acquire companies. So we did it in 2022 with Eveloiva, a very nice success story. And now it's RBC. The VAT industry, when we are looking at the European one, is fragmented. We see a lot of opportunities. Small and medium companies, they are in the ceiling roof. Either they don't have technology to break this ceiling roof, and they need to invest millions in order to get there. And for them, the options are to sell the company or to invest millions of dollars to provide the right technology, AI, and to take them to the next step. For us, it's an opportunity. We are seeing some companies that still can be relevant for us. So we have a very strong pipeline for M&A. We have our own investment banker in London working with me on some potential acquisition in the future, and we very much would like to expand it. So the idea with the RBC that we acquired just recently is to provide more revenue for sure, profitability for the company, because this is a profitable company, and a client's footprint, about 80 different clients. The idea is to provide our technology to that company. Today, they do all their activity manually. So, of course, having them on our platform reduce cost, and also to provide their clients some more benefits. The last pillar is the e-invoicing. E-invoicing is kind of mandatory on a few countries and is going to be mandatory in Europe. This is the big thing in the tax area in the next few years. Companies that should go under the regulation in order to place their invoices to clients or getting invoices from their suppliers should be under those regulations. Way2V developed that technology. It's available. We developed it in Spain. We very much now would like to commercialize that. So early next year, we will start selling this product. Again, this is SaaS model, not any fees or kind of contingents or success fee, SaaS fees. We see the demand from our clients. We have a discussion with our clients. Bear in mind that Way2V has about 400 clients, so it's a big space to have a conversation with clients to see the appetite that they're having in the invoices, and the appetite is very high, I would say, and it's there. So the e-invoicing, you can see here, became mandatory in the countries that you can see below. Some in Europe, like in Germany, in Poland, Portugal, Romania, Greece, and Latvia, and Asia Pacific, in Malaysia, Singapore, India, and Vietnam, and in Americas, Brazil, Mexico, Chile, Colombia, and Peru. This is just a first step. Other countries will join in the next few years. We very much would like to be a major player. This is, in the end, this is part of our solution. We are based on invoices. All our businesses is invoices on invoices, invoice validation, and we very much would like to continue that, capturing the invoices, looking on the invoices, see if the invoice is compliant in terms of VAT and GST, and then move it to the e-invoicing platform. So technology-wise, this is a triangle solution between the supplier, Way2V, and the tax authority. So we develop that platform. Any invoice that the client will upload to our platform, we will check it real time with the tax authority. We'll get the digital signature, and from that, the client can potentially pay this, or can also move it to their clients, like account receivable invoice, AR invoice. In terms of TAM, I said the first pillar represents 20 billion, so we are increasing the TAM dramatically to about 170 billion TAM in USD. The most we can see the most growth will come from the e-invoicing. In 2032, this market will potentially represent about 58.5 billion US dollar. Also, the VAT advisory is growing because a lot of technology is coming in to all this tax domain and also in this financial area. So we see more and more requests from clients to have advisory and support from different companies, and we would like to be part of that with RBC to give top advisory to our clients and consultancy to our clients in terms of the GST and the VAT reclaim. So this is a market size about $95.5 billion. So it's by any means it's a big market. There is no any ceiling roof. Really, the sky is the limit here. I would like to present you the four-pillar strategy and to show you the end-to-end solution in one platform. So in the right side, you see Way2VAT, Way2VAT client. So we will start having the VAT reclaim, getting the invoices in very large scale. And then we validate them, and then we do the VAT reclaim in front on 40 countries. Then we do the VAT compliance. This is for any invoice from different suppliers around the globe, online SaaS model platform. And then we go through the API. And then from this API platform, after we do the VAT compliance, we move it to the invoicing. The invoicing to get the digital signature that the invoices is not a fraud. As said, countries in Europe and also in APAC each country losing billions of dollars in euro yearly because of fraud of invoices when it comes to VAT and GST payment. And they would like to avoid it. And doing that by real time online, the way we are presenting that, really can reduce this potential loss that countries is having. So we can provide after the clients are getting the green light through API platform, we will move it to the invoicing, and by then we close the loop. It's the end-to-end. So we can do it from VAT reclaim to the invoicing, and for the invoicing to VAT reclaim. If you look on the other clients, if they have it, if they're doing that manually, or they're doing in-house, or they're doing with third party, our competitors, each time that they have an issue with the VAT reclaim, they need to go out, they need to look for other platform, they need to check it more closely. It's more manual job, more cumbersome, more complicated, and then moving into the e-invoicing platform like a third party one, much more complicated. And we are saying we have a one platform end-to-end in one solution. Clients, you can see a very short list of clients here, yeah? So you can see CBRE and TikTok and MasterCard and JLL and Sony Picture and Ali Lilly and Amdocs and Foot Locker and Solenis and Aviva and Nestle and BASF, so and Duracell, NetApp. So this is a short list of clients. As said, we are targeting a very large client, just enterprise. This is our business, and in the next few years, we will concentrate on very large clients as well. A bit about RBC acquisition. So this is a company we acquired just in the beginning of October. As said, it's about we will get about 3 million Aussie in revenue. It's about 1 million profit Aussie. Their clients in different vertical, pharmaceutical, tax, accountancy, automotive, technology, construction, and retail. They're based in London, so there is a lot of value that we have our London team in Way2VAT, so we'll merge the two teams to one in London. So we very much welcoming them to Way2VAT family. The idea to acquiring RBCs to get the company will take us to about 500 clients globally. As said, RBC revenue, it's about 3 million Aussie, 1.5 million pounds. It's a profitable company, will contribute to our profitability. So this is one of the main incentives for us having this deal. We see a lot of cross-sell opportunity between both companies. So Way2Vat clients will use in the near future RBC as a consultant, main consultancy player to our clients, and vice versa. For RBC clients, we can provide Way2Vat solution, the VAT reclaim, the APAI solution, and the invoicing. By then, we see that at least this year, in the next 12 months, we will show a growth just for RBC, about 20% minimum growth in terms of revenue. And then this really can take us, as said, to profitability this year by having that, getting additional revenue and about 70 to 80 new clients really contribute to that direction, to profitability. We will have, as I said, operational synergies between the teams, one team in London. That's it from my side this afternoon. Happy to answer for any question. Thank you, guys.
Thanks, Amos. Yeah, just a quick one for me on the integrations of some of the new products. Is it an API that connects into, if we take Nestlé there, as one of the customers you highlighted, whether it's the invoice validation or the e-invoicing, does that natively go into their accounting system or ERP system if they're running Oracle or SAP or whatever they're running? Or is it a standalone system that sits outside that they push everything through the engine, and then the ones that are fine can get uploaded into the main system?
Yeah, it's varies between companies, but for the VAT reclaim, we are connecting to the via API to the Oracle and to the SAP or those big accounting players. So we have our own connectivity API that we developed, and we're getting that almost real time. When it comes to APAI, could be the same solution, or we can get invoices by SFTP, very large one. Client has his own policy how they would like to upload invoices when it comes to prepayment, because APAI, we very much would like to capture the invoices before they do the payment, and mostly before they upload it to the ERP. So most likely they're getting all those invoices to like email, like a large inbox. And we very much would like to connect to those inboxes and get all these invoices to our API platform, validate them, and then to move it back to their ERP solution. So this is the idea for API. For e-invoicing, is the same. So e-invoicing, we have a kind of dual connectivity for ERP solution. In one hand, it's API that can get invoices in very large scale to our platform. And once we do this digital signature, we can move it back to their platform. So it's dual connection.
Okay. And then just you talked about the quarterly revenue, a very strong quarter. Seasonality in terms of revenue, given you're in 40 countries, does it all just kind of like even out, or is there?
Because when it comes to VAT reclaim for the first pillar, we have a seasonality. Mostly you can see the Q1 is the quieter, I would say, quarter in terms of revenue, the slower one. And it goes up. Q2, we have a deadline, the June deadline, the June quarter. So you see some growth there. And then September quarter, as this quarter, we show a record in terms of revenue. Also, there is a deadline there for countries to reclaim VAT. And then end of the year, so we have mostly one deadline in the UK. This is the December quarter. So there is a seasonality for sure. But if I need to summarize with that, Q1 is I would say, the weakness one.
Okay, Q1. Okay. And then you touched on margins there, the 82 or 83%, I think, is the overall margin. Should that increase, kind of remain stable as kind of the four pillars are built out over time?
We very much would like to keep that think 82% gross margin is a very nice margin for a company like that, slim and lean in terms of operational cost. And the idea is to keep that.
Okay, so as the four pillars start to evolve and
Yeah,
grow and
yeah,
contribute,
yeah, yeah. I
you're not
think it's all
expecting
about
a big change from that level.
no, no. It's all about technology. So, the cost is mainly Amazon AWS and some operational resources that we have internally. But most likely, it's very efficient.
And then just on APAI, is it pure SaaS based? I know you said that there's different
Yeah,
packages they
it's a
can base,
pure. It's a
but
it's a
it's
pure.
not based on the the volume or value of transactions that
No,
goes
no,
through.
no.
You get a
It's
package
not
for
about
500 or
the VAT
1,000.
reclaim. No, it's not about the VAT reclaim that we are getting fees like let's say 20 cents on dollar,
Hmm.
like a rev share. Here it's a SaaS. It's based on packages. So minimum package is 500 invoices per month, and it goes up to 50,000 invoices per month. So it's purely SaaS fee and a commitment for clients, it's at least 1 year, 12 months. So we are entering to be a normal SaaS company.
Okay. Okay. I just wanted to check when you said the packages, I just wanted to see was there a fee on,
Yeah.
processing the 500 or the 1,000 or whatever the
No,
number of
it's a SaaS,
invoices.
it's per package. They are buying the package and that's it.
Okay.
If they want to move to one package to the second one in terms of size, of course they can do that.
Okay.
But there is a fixed monthly cost.
Okay. And in terms of the new clients that you can now at least open conversations with as the RBC team has kind of come on board or is being integrated, are they primarily UK Europe based or are they like a global consultancy
They're
just
based
based
in
out of London?
London. They're based in London. They are British. Their business mostly is in Europe. They have big American companies that they are consulting them in the last 15 years. Mostly companies that in area of production of goods, if automotives or other, I showed the verticals before. And for those Americans that they have business in Europe, they are working with them closely. Cross-border issues that they have in terms of VAT, VAT registration in the different countries they can do, and also VAT reclaim. So yeah, this is the services that they are providing.
And transfer pricing, it goes along with that between the US
Yeah,
entity and the European entity.
yeah,
Okay.
yeah.
Amos, we're just gone over time there, so I don't want to take up any more of your morning there or anybody else's evening on the Australian side. So thank you very much for joining us and good luck with the
Perfect.
implementation and the integration of the new acquisition. And hopefully we can catch up
A
sometime
lot
in the
of
new
things
year.
are running now in way to that. This acquisition really can take us to profitability and growth in revenue. This quarter that we announced just yesterday with a record of 1.889 million Aussie dollar revenue, it's a record. And next quarter it will be higher. So a lot will come shortly. A lot, I would say, good news. So we are looking forward. Thank you very much for your time.
Cheers. Thank you, Amos. And thanks everyone for joining us this afternoon. And we'll have another webinar tomorrow. We've got Straker Translations at 11:30 and Vinyl Group at midday for anybody who wants to join us for tomorrow's webinar. And with that, I'll wish everybody a good rest of their day. Thank you.